Hi there. So today I'm going to explain what tax loss harvesting is. If you're a bit confused just hearing that term, know that you're not alone because it's probably one of the more confusingly termed concepts in finance, and I really wish we could rename it. But first, before I dive into that, why does this matter? Let's start to think a little bit more about how you calculate how much you've built wealth at the end of a year. There is a formula that we can use here. Building wealth is income, what you're earning, minus what you're spending, minus your taxes, and very specifically, the investment returns you also earn that year. Wealthy folks talk about taxes a lot because taxes can really add up. Let's say you're earning $100,000 in New York. You're probably paying at least $32,000 in taxes that year. And that's assuming you also haven't invested in things where you might pay interest tax, capital gains tax, or dividend tax. For most folks, it's hard to feel like there's anything you can do except for cover your eyes and just keep paying your taxes. But a really important part about investing in financial planning is to look for legal opportunities for reducing or delaying your taxes. For our direct indexing portfolios, how you invest with us, the impact of reducing taxes can be so large that we estimate that it gives investors an additional 2 to 4% in higher after-tax returns per year, depending on your income. This is a basic example of how that works. Say you invest in an ETF with $10,000 and you hold it for 1 year and it grows from $10,000 to $10,600. You've now gained $600. If you want to sell any of that, you're going to have to pay some amount of taxes because some amount of that went up. Now, instead of investing in that ETF, imagine you invested in 3 different stocks. With direct indexing at Plenty, you're actually holding roughly 80 to 90 securities per portfolio, but we're gonna keep it simple for now. Let's say one goes up a lot, one stock goes up a bit, and one goes down a bit. And if you're looking to pull money out, the first place you wanna look at is the one that went down a little bit. And then you don't have to pay any taxes on that, but you also create a loss and a tax credit that can be used against other gains. When we're talking about tax loss harvesting off of your whole portfolio, we look for all these different opportunities for stocks that go down, create a tax credit, we sell something that went up, and we immediately use that tax credit. We then take all of the funds and reinvest into a different stock so we can start fresh the capital gains clock. Now you can't buy the same thing, but you can sell Coca-Cola and buy Pepsi. And that's another way that Plenty gives you the ability to invest like the 1% by earning an extra 2 to 4% in after-tax returns per year. Thank you.